Okay, let's unpack this. Welcome everyone to the deep dive. Coming to you today on the Reading Cowboys YouTube channel. We're about to jump into something that, well, for a lot of us feels like the ultimate dream, passive income. You know the picture, right? Money just flowing in while you're out living life, maybe traveling, maybe just reading a good book. But here's the thing we need to tackle right away, that passive part. It's often more myth than reality, maybe a clever marketing angle, as some folks on Reddit pointed out. Getting income that feels passive usually means a lot of upfront work and often some ongoing effort too. So our mission today, cut through that noise, explore what real passive and maybe more importantly, semi-passive income looks like for 2025, and give you some practical tips, stuff you can actually think about using today. We've looked at Bankrate, Cleverance, PwC, Financial Samurai, and yeah, those really honest Reddit chats.
Yeah, what's really fascinating is how much this idea has grabbed people, especially with everything changing economically, people wanting more financial freedom. It's a concept that really needs a bit of a reality check. It's vital to get that this isn't about money for nothing, but the right strategies. They can genuinely create some breathing room financially. They can be powerful wealth building tools. It's about smart choices, really, not magic.
So let's get right to it for you. This whole idea of passive income.
Yeah.
How real is it? Is it just, online guru talk?
That really is the core question. And actually, that Reddit discussion gives a great sort of grounded view. They found a lot of things sold as passive actually need significant upfront effort, continuous oversight, and regular adjustments. So definitely not a walk in the park. When we talk truly passive, like zero ongoing effort, that usually needs huge amounts of capital. Think managed mutual funds, big portfolios where pros handle everything. You're basically paying for the passivity. What's much more common and probably more realistic for most of us is semi-passive income. That means you put in a ton of work at the start, build something solid, and then the day-to-day work gets much lighter. Like that Reddit user, right? 8 years building a client base now makes $1,500 a month just answering some emails. That's a fantastic semi-passive stream. So the actionable thing here is maybe shifting how we think about it. Instead of purely passive, maybe think perennial income. I like that phrase from Reddit. It's like a product or platform that runs all year with just minor checks. But you got to acknowledge that initial slog. It grows back each year, like a plant you worked hard to establish.
I really like that reframe perennial income. Yeah, it keeps the dream alive, but adds that dose of reality, makes it feel more achievable, actually. Okay, so to help organize this, Bankrate had this list, 25 passive income ideas, and it kind of sorts them into two main buckets, right, depending on what you're starting with. First, there's the upfront work-heavy stuff, good for those with, little or no money to start using your skills, your time. Then there's the money-based path for folks who have some capital to invest and want more purely passive returns from that money. Let's dig into the upfront work-heavy ones first. I think these are super relevant for a lot of people listening who maybe don't have a big pile of cash ready to invest just yet. It's about time and skills.
Exactly.
Yeah.
So first up, ebooks. Creating and selling informational ebooks. Big opportunity here. It's not just the sales, though. They're powerful as thought leadership magnets.
Right.
They show what, drive traffic to maybe courses or your website. The catch, the book has to be genuinely good. And you need decent marketing. Otherwise, you spend all that time for, well, not much.
Yeah.
A smart approach is starting with something you're already an expert in. Make content that really proves your chops.
Right. And sticking with that creative theme, what about selling photography online? If you've got a good eye.
Yeah, another good example. You can license photos through places like Getty Images, Shutterstock. The potential upside is scale sell the same picture over and over. The challenge, often only a few photos really take off. It takes real effort, shooting, processing. You should probably focus on figuring out niche demands, like what specific kinds of pictures are missing out there that people need.
Finding that gap in the market. Okay.
Yeah. Or if you're into coding, maybe creating an app, a game, a utility. Huge potential if it catches on, right? Income from ads or fees. But it is a very crowded market. Your app needs to offer real value, be compelling, and privacy laws. That's important too. The advice here is maybe focus on a hard-to-do function for mobile users, or just a really unique game idea, something that stands out. Then there's creating an online course. Audio, video, platforms like Udemy, Skillshare. This can be a really solid income stream after that initial big effort. A freemium model could work too, build up a following, but the source warns it takes a massive amount of effort to create the product, and it must be great.
No half measures.
Right. And you need marketing. A practical tip, build a strong platform first, maybe plan for more products down the line, because, one product is not a business unless you get really lucky.
Makes sense. Build an ecosystem. And for the designers listening, selling designs online, t-shirts, mugs, that kind of thing.
Yeah, places like Cafe Press, Etsy, Zazzle, it's another creative route. You can jump on current events, trends. And the upfront investment is low if you use printing partners. They handle the stock and shipping. The risk, it can be a lot of time for maybe a little payoff, unless you're already doing design work anyway. It's the actionable tip. Keep an eye on what's trending. Create designs that kind of capture the spirit of the times.
Ride the wave? Okay.
Affiliate marketing is another big one people talk about. Promoting other companies' products with your links, website, social media. In theory, it's passive once the links are up. Commissions are usually like 3 to 7%. But you need serious traffic to make real money, which means consistent content. You need to draw people in.
So the passive part only kicks in after a lot of active audience building.
Pretty much. A smart move is growing an email list or a social following in a niche that pays well. Think software, finance, fitness, things like that.
Gotcha. Okay, lastly for this category, a really practical one. Renting out assets you already own, like a parking spot. Or household stuff like lawnmowers, power tools. I like the idea of my lawnmower finally pulling its weight instead of just sitting in the garage.
Exactly. It's pretty low risk if you already have the items. And returns can be high in certain areas, like near stadiums or venues. The downsides, obviously, are potential damage, theft, maybe liability issues.
Right, insurance and stuff.
Definitely. So practical tips. Check local rules first. Use contracts or disclaimers. Maybe start small. And figure out what high-value things people might need just for a short time.
Okay, that covers the work-heavy side. Now, what about folks who do have some capital? How does the game change then?
Right. So here, the effort shifts more from creating something yourself to making smart investments. Different risks, different rewards. Dividend stocks are a classic example. These are companies paying out a portion of their profits to shareholders, usually every quarter. They're great because you get income without having to sell your shares. Plus, you can reinvest those dividends that's compounding. Really powerful for long-term investors, retirees.
Okay, sounds good. But how do you actually choose the right dividend stocks? Seems like you could easily pick a dud.
Yeah, there's definitely a method to it. You want companies with a solid history of paying reliable and growing dividends. Looking at the dividend yield, sure, but also check if they have enough profit to actually keep paying. Cleverance mentioned some names for potentially looking at in 2025, like Johnson & Johnson, J&J, Procter & Gamble, PG, Coca-Cola, giants with long track records of raising dividends. The risks, though. Companies can cut or stop dividends if they hit hard times. And the stock market itself is always volatile.
So what's the key advice?
Definitely diversify your portfolio. Don't put all your eggs in one basket or even one sector. Reinvest your dividends if you want growth. Keep an eye on your investments. Don't just forget them. And consider tax-advantaged accounts. If you're self-employed or a small business owner, things like a SEP IRA or a solo 401k can be huge. You defer taxes on that income and its growth. Really boosts long-term passive income potential.
Got it. Beyond stocks, you also mentioned bonds and CDs. How do they fit in?
Right. Bonds give you income through interest payments. Retirees sometimes use a bond ladder, staggering maturities for regular income and managing rate risk. The risk with corporate bonds is the company could default. And if interest rates go up, the value of existing bonds tends to go down. CD, certificates of deposit, and high-yield savings accounts, they're among the safest options. Your principal is usually FDIC insured up to a limit. But the downside is the returns can often pale in comparison to inflation.
So your money's safe, but it might not be growing much in real terms.
Exactly. Good for preserving capital, maybe for diversification, but probably not your main engine for growth.
Okay. Then there were annuities. These sound a bit more complex.
They definitely can be. Essentially, you pay an insurance company, and they promise you a future stream of income. They can seem like the definition of passive income. You set it up, then payments arrive. And payout structures can be flexible. However, they're often tremendously complex. Your money can be locked in for a long time with big penalties if you need it early, and they usually require a large chunk of money up front.
Sounds like something you need to be really careful with.
Absolutely. The crucial tip here: read all the fine print. Seriously. And get professional financial advice because they are just so complex. Don't go it alone.
Wise words. Okay, let's shift to a really big one. Real estate. Always generates a lot of buzz, right? Owning rental properties directly.
Yeah, it can offer high returns, potentially less volatile than stocks day to day. Financial Samurai even talked about seeing huge profits, like 70% plus, after holding for years. But Like we heard from that Reddit discussion, it's often not truly passive for most owners. You might get horror tenants, deal with damages, vacancies, economic slumps hitting renters. It always needs management, even if you hire a property manager, which costs money, obviously.
Yeah, those late night calls are definitely not passive.
Exactly. One interesting tip, though. Consider triple net properties. Think warehouses, maybe some grocery stores. The tenant pays for almost everything: taxes, insurance, maintenance. Much less work for the landlord, but usually requires more capital up front. And a general rule: provide a quality residence to attract quality residents. Treat it like a business.
Makes sense. What about getting into real estate without being a direct landlord, like crowdfunding or REITs?
Right, those are more hands-off options. Crowdfunding platforms let you pool money with others to invest in specific deals, often commercial properties you couldn't afford alone. Access to private deals without direct management. REITs, real estate investment trusts, are companies that own or finance income-producing real estate. You buy shares like stocks, they often pay dividends, and they're traded on exchanges, so they're liquid. The risks. Past performance isn't guaranteed, obviously. You need to vet the deals or the REIT management carefully. Real estate is cyclical, prone to downturns. Crowdfunded deals might lock up your money for years, and REITs can cut their dividends too.
So still need to do your homework.
Always. Diversify across different platforms or REITs. Understand what kinds of properties they actually hold.
That gives us a great overview of the established options. But you mentioned PwC's report on emerging trends for 2025. What's changing in real estate that investors should know about?
Yeah, that report showed this mood of cautious optimism. There's still big concerns: geopolitics, shaky economy in places like Germany, high interest rates making financing tricky. But some sectors are doing really well. Logistics, like warehouses, still strong. Storage facilities, and different types of housing, student housing, private rentals. What's really hot, though, and seen as top prospects for investment: data centers and new energy infrastructure.
Driven by AI and the cloud.
Exactly. Demand is massive, vacancy rates are super low. So a practical tip: if you're looking at real estate, these specialized areas have high potential.
Yeah.
But you do need to understand how they operate. They're not like managing an apartment building.
And ESG, environmental, social governance, that's still a huge factor.
Huge. It's unavoidable now, really. Properties considered brown, the ones without a clear plan to get to net zero emissions or finding it harder to get loans, they risk becoming obsolete. Insurance is another angle. Costs are rising, especially for properties in flood or wildfire zones. Getting insurance at all is becoming tough in some areas. On the flip side, green buildings with strong ESG features. They're attracting money and tenants. So the takeaway is critical. Factor ESG in from the very beginning of any real estate plan. The report literally says, you won't get a loan today unless you have an already sustainable building or a CapEx program budgeted to attain sustainability.
It's non-negotiable.
Pretty much. Even simple things help, like designing buildings to move critical equipment higher up if it's in a flood zone.
And technology, AI, how's that playing out?
It's being used more and more. For market analysis, trying to predict tenant behavior, managing properties more efficiently, but that also means rising cybersecurity concerns. It's a double-edged sword.
So embrace tech, but be careful.
Exactly. And one last point on location. London, Madrid, Paris are still top for sheer market size and liquidity. But there's growing interest in secondary cities for residential investment. Places like Florence, Seville, Malaga, Valencia. Also cities known for quality of life like Copenhagen, Amsterdam, Vienna. Warsaw's rising too.
Interesting. So maybe look beyond the usual megacities.
Could be opportunities there, yeah. Look for places with good economic growth, transport links, quality of life.
Okay, that's an incredible amount of detail. But honestly, with so many choices and hearing about all the risks and complexities, how does someone listening avoid just getting stuck? Analysis paralysis. Where do you even start? And how many streams should you aim for?
That's the million-dollar question, isn't it? Okay, Let's break it down. If you're starting with little or no money, focus where you have expertise. Design, writing, coding, whatever it is. Then pick one of those upfront work-heavy options. Build a course, grow an audience for affiliate marketing. You're basically substituting your time for your lack of capital.
Trading sweat equity for future income.
Exactly. Now, if you do have capital, then you look at things like dividend stocks, preferred stocks, or REITs, or maybe safer options like bonds or CDs if preservation is key. These generally need less active effort once the money's invested.
Okay, so pick the path that fits your starting point. What about how many? Is more always better?
Well, there's no one-size-fits-all. Greg McBride at Bankrate had a good line. You'll catch more fish with multiple lines in the water. Diversification helps. But you've got to balance that. Spreading yourself too thin means nothing gets the focus it needs. Don't just add streams for the sake of adding them. Maybe start with one or two that really fit your skills or capital. Get them working well, understand them, then maybe think about adding another.
Master one before juggling too many. Makes sense.
And one really important practical point, especially if these streams start generating decent income taxes. Depending on the income type in your situation, you can often minimize your taxes. This might mean setting things up as a formal business. And definitely looking into those self-employed retirement accounts we mentioned, a solo 401k, a SEP IRA, they let you shield a lot of that income from taxes now.
Which can make a huge difference over time.
A massive difference. But the crucial tip here, this stuff gets complicated fast. Always talk to a qualified tax professional. See what applies to your situation. Don't rely on general advice for tax planning.
Excellent point. Wow. Okay. We have covered a ton of ground today, from busting the passive income myth to specific strategies using time or money, even future trends in real estate. As we wrap this up, what's the single biggest thing you hope people listening take away from our conversation?
I think if we tie it all together, the key thing to understand is that building real financial freedom, maybe through passive or semi-passive income, it rests on a foundation of deliberate effort and smart choices. Whether you're investing your time up front or investing your capital wisely, or maybe a mix of both, it takes patience, planning, diversification, and just staying curious. Keep learning. It's definitely a marathon, not some get-rich-quick sprint.
A marathon with a potentially amazing finish line. Well, thank you for diving deep with us today. That was incredibly insightful. And for everyone listening, as you think about your own financial goals for 2025 and beyond, here's a thought. What's one non-passive, concrete step you can take this week? Just one thing to move a little closer to building the kind of diversified, sustainable income stream we've been talking about. Maybe it's researching that skill for an ebook. Maybe it's setting aside just a small amount to start exploring dividend stocks. Or maybe just looking around at what assets you already own that someone else might pay to rent. The knowledge is here. Now it's about taking that first step. Thanks for joining us on the Deep Dive, and we'll catch you on the next one.